Hi guys, hi from Andrea Unger, pyramiding or scaling in, scaling out. One of my past videos, I was mentioning how dangerous it was to average down your position. It was dangerous because you have, from a psychological point of view, not acceptance of losses. Dangerous because you expose more and more on a weak underlying, it's going down and you buy more and more, and for many other reasons. So somebody wrote on my blog, it's fine, I like this, but what's your opinion about scaling in, pyramiding, increasing a position, a winning position? So here we go. Pyramiding makes sense, in my opinion, only if you keep a constant control of your risk. And if this still lets you make more money, netting positions from commissions, costs, and so on. What does this mean? Imagine today you enter with one contract and you keep this position for 10 years, okay? 10 years it goes up, you make a lot of money. If every month you would jump in with another contract, in the end you will have more money, this is clear, because the position went up. But if you enter with a whole size, you distribute it along the path at the very beginning, you understand immediately you will have even more money because every single contract would have gained the whole move, while scaling in, the contracts entering later obviously make less money because they enter at a higher level, so they have a smaller distance to travel. But you don't know from the very start if the move will be that big. So this is sort of an anti-martingale, okay? Somebody sells this as anti-martingale technique and so on. Does it make sense? It makes sense if, first of all, if you have this long-lasting position, long horizon, because obviously you have to take attention. Imagine you enter today here and you decide to enter with one contract because one contract is the size that keeps your losses in case of stop loss below 2% of your equity. 2% is your decision, my decision in this case, okay? My decision is 2% because my risk profile is telling me that 2% is fine with me, okay? Now, once your position goes up, it might happen that after 1 month being here, you have this portion of open position profits, and this portion of gain could allow you to add one more contract because the new capital you have, closed position plus open position, applying still the 2% of risk, would allow you to absorb stop loss with 2 contracts instead of 1. You have more money, so you might have high exposure. And consider also that after this move, you might have moved your stop loss up. You know, I don't like trailing stop, we discussed, but on such a long time horizon, you obviously adjust stops. So imagine at the new level of stop, if I exit here with my contract, I would lose only 1%, so I could add the second contract because pulling out 2 contracts would still keep my total losses on current stand of my equity at 2%, below 2%. So keeping the risk profile, the risk of your position at the same level which you define because of your risk profile, you can scale in and you take maximum advantage of the power of position sizing. This is the way to apply it on an open position, while normally you do it when you enter the next position. You close one, you have your close balance, and you make your maths on the following position. Here you have a long-term trend following, and obviously the only thing you can do is to add contracts to your winning position. You are not entering because you believe in the strength of that market. Be careful. You are entering because your risk profile allows you to do so, as you are still keeping your overall risk in that very moment below your risk threshold. In this case, example was 2%. You have more money, 2% of more is more, and that more you are allowed to risk in case of stop allows you to add 1, 2 or whatever contracts to your position. And this is the right way to do it if you want to do it, in my opinion. The martingale, which is, and the anti-martingale, which is sold out there from some mentors, is dangerous when it applies to completely absorb your margins, and as soon as you have some free margins you add contracts because you have more power in your balance. But obviously you have to consider that if you go up with one contract, once you go down with 2 contracts, you lose twice as much. So you have to consider how much you lose when you increase your position. And if you just base your decision on margins, you can really wipe out very suddenly and very quickly your account if you increase too much with no specific risk control in your account. So I don't like the anti-martingale as is based on margins, but I do consider the increase of a position size based on risk control. That said, you can write your comments about your approach, your knowledge about anti-martingale, and your thoughts about this approach that I just mentioned. This scaling out is another technique, has nothing to do with this. It's a technique where you are told to enter the position with multiple contracts and close some at specific points, maybe 3 contracts, one when you cover costs, another one at break-even, and another one is gain, whatever. So this is a pure psychological issue. I mean, I'm nothing against this, but if you do so, let's say you have 6 contracts, one is closed here, 2 here, 2 here, and 1 here, you have 4 different exit techniques. You should do the following: split your system into 4 systems and evaluate the original system with a single exit at a certain point and the sum of the 4 systems with the same number of contracts, obviously, at the different levels. You will notice that on the average, on the overall path of your trading system, the original exit makes you more money. It might happen that sometimes scaling out leads you to protect your gains or even to make gains while the original exit could turn into a loser. But overall, normally, the original and single way to exit brings more money than the scaling out technique. But if scaling out is something you like because you have a good feeling, because you feel fine with it, because you have a feeling to protect your gains, whatever, but let's say you trade in a more relaxed way, knowing that you can scale out, then do it. It doesn't matter if you make less money, but making a lot of money under a stressful condition might lead you to mistakes, errors, which might even be costful in case you don't respect your plan. While if scaling out is something that makes you feel, well, perfect, do it, but don't think you're doing that to make more money just on a plan base, because it's not like that. Normally it's not like this. It's something that people tell you to sell you something beautiful, but the beauty is only in the psychological aspect behind it. That's my opinion. Write me your opinion about this if you have an experience about it, and keep in touch. See you next time. Ciao from Andrea Unger. Enjoyed it? Click the link below and you will be noticed as soon as new material is available.